The Engines of the Future, a comprehensive guide to the iShares MSCI Emerging Markets ETF, EEM. As of February 27, 2026, the iShares MSCI Emerging Markets ETF, ticker EEM, stands as one of the most significant and storied vehicles for accessing the world's fastest-growing economies. While the early 2020s were defined by U.S. mega-cap dominance, 2026 has marked a distinct tactical rotation. Emerging markets, or EM, entered this year with renewed strength, supported by a global interest rate cut cycle and a historic boom in artificial intelligence hardware that has turned several developing nations into indispensable tech powerhouses. For an investor today, EEM is the granddaddy of emerging market funds. It provides a massive, liquid slice of over 1,200 companies located in countries like China, India, Taiwan, and South Korea. This guide explores the Silicon Shield of Asia, the valuation gap of 2026, and why this particular fund remains a favorite despite newer, lower-cost rivals. 1. What is EEM? The Emerging Market Blueprint. EEM tracks the MSCI Emerging Markets Index. To understand this fund, you must understand how emerging markets are defined. These are nations that are transitioning from developing to developed status, characterized by rapid industrialization, expanding middle classes, and increasingly sophisticated financial markets. The Geographic Footprint, 2026 estimates. Emerging Asia, approximately 78%. This is the core engine of the fund. It includes Taiwan, 20.2%, India, 15.3%, South Korea, 13.3%, and China, 10.7%. Latin America, approximately 9%, dominated by Brazil and Mexico, providing exposure to natural resources and nearshoring manufacturing for the United States. EM Europe and Middle East, approximately 12%, including nations like Saudi Arabia and South Africa, offering a mix of energy giants and growing consumer markets. By buying EEM, you are effectively betting that the 6 billion people living outside the developed West will continue to consume more, build more, and innovate faster than their counterparts in the aging economies of the US, Europe, and Japan. 2. The 2026 Catalyst, the AI hardware supercycle. In 2026, the primary reason to own EEM isn't just cheap stocks, it's artificial intelligence hardware. While the U.S. owns the software of AI, like OpenAI and Microsoft, the physical components are almost entirely an emerging market story. The top 3 anchors. Taiwan Semiconductor Manufacturing Company, TSMC, accounting for roughly 12.5% of the fund. TSMC is the world's only producer of the most advanced AI chips. As global AI spending hits record highs in 2026, TSMC's earnings have surged, buoying the entire ETF. Samsung Electronics, South Korea, at 4.7% weight, Samsung is a global leader in high-bandwidth memory, HBM, the specialized memory required for AI servers. Tencent Holdings, China, at 4.5% weight, represents the internet and cloud side of AI, integrating advanced models into a billion-user ecosystem. The Silicon Shield. Investors in 2026 often referred to the semiconductor hubs of Taiwan and Korea as a Silicon Shield. Their global importance to the AI economy is so great that it provides a level of economic resilience that many other regions lack. 3. Performance Snapshot, the 2026 Rebound. After a period of sluggishness in the early 2020s, EEM has staged a powerful comeback. Financial Vitals, as of February 27, 2026. Price, approximately $63.12, trading near 52-week highs. Year-to-date return, approximately 14.3%. EEM has outpaced many developed market benchmarks so far this year. 1-year total return, approximately 33.3%. This reflects the Sell America rotation, where investors shifted capital into undervalued international markets. Dividend yield, approximately 2.05%. While not a high-yield fund, it provides a consistent semi-annual payout that is higher than the S&P 500's average. 4. Cost analysis, the .72 question. If there is one red flag for EEM, it is the cost. Before you invest, you must understand the expense ratio. EEM, 0.72%, versus IMGE, 0.09%. iShares, BlackRock, actually offers two versions of this fund. EEM is the original fund. It focuses on large and mid-cap companies and has an expense ratio of 0.72%. IMGE, iShares Core MSCI EM, is the core version. It is much cheaper, 0.09%, and includes smaller companies. Why does anyone buy EEM? Because EEM is one of the oldest ETFs in the world. Launched in 2003, it has massive liquidity. Massive institutional investors and hedge funds use EEM because they can trade billions of dollars of it in a few seconds without moving the price. For a retail investor, EEM is the prestigious choice, but for long-term buy and hold savers, the cheaper IMGE or Vanguard's VWO are often more cost-effective. 5. Sector concentration, a modern economy. Forget the old image of emerging markets as farms and mines. In 2026, EEM is a technology-first fund. Information technology, approximately 28%, the largest sector, driven by the semiconductor giants of North Asia. Financials, approximately 21%, featuring massive banks in India and Brazil that are benefiting from high interest rates and digital banking revolutions. Consumer discretionary, approximately 11%, including e-commerce giants like Alibaba and Meituan. Communication services, approximately 9%, home to internet and social media leaders. 6. Critical risks, the three geopolitical pillars. Emerging markets offer high rewards because they carry high risks. In 2026, there are three specific risks that could derail your EEM investment. Geopolitical tension, Taiwan and China. Since 30% of the fund is concentrated in China and Taiwan, any escalation in regional tension instantly impacts the stock price. While bamboo diplomacy has kept things stable so far in 2026, this remains the #1 tail risk for investors. Currency volatility. EEM is an unhedged fund. This means you own the stocks in their local currencies, yuan, won, rupee. If the US dollar suddenly gets stronger, the value of your EEM shares will drop, even if the stocks themselves stayed flat. In early 2026, the weak dollar trend has been a tailwind for EEM, but this could reverse if US inflation spikes again. Governance and regulation. Developing nations can change the rules of the game overnight. We saw this with the Chinese tech crackdowns of previous years. In 2026, investors are watching India closely to ensure that its pro-business reforms continue following the latest round of domestic policy shifts. 7. Strategy. How to use EEM in 2026. For the average investor, EEM serves as the growth engine of a diversified portfolio. The 10 to 20% rule. Most financial advisors recommend a 10 to 20% allocation to emerging markets. This provides enough alpha, or market-beating potential, without making your entire portfolio too volatile. The value play. As of February 2026, the S&P 500 is trading at a PE ratio of 23x. EEM is trading at a PE ratio of 14.5x. This means you are buying emerging market earnings at a 37% discount compared to U.S. earnings. Pairs trading. Many 2026 investors pair EEM with a safe haven asset like gold, IAU, or short-term treasuries, SGOV. When EEM is booming, you capture the growth. When geopolitical news gets scary, your safe haven assets provide the ballast to keep you from panicking. Conclusion: the essential international frontier. The iShares MSCI Emerging Markets ETF, EEM, is the definitive way to own the rest of the world. It is a fund that has successfully navigated 2 decades of global shifts, from the original brick boom to the current AI hardware revolution. While its 0.72% fee is higher than newer rivals, its sheer liquidity and blue-chip portfolio make it a trusted anchor for those who want exposure to the future leaders of the global economy. The verdict: if you are a long-term investor who believes that the centers of global power are shifting towards Asia and the global south, and you can stomach the volatility of a 3.7 beta asset, EEM is a premier choice for your international